we have a great presentation for you on tax strategy solutions for business sellers. It is by Asset Strategy. Our Asset Strategy for over 30 years. Asset Strategy is a network for over 30 years. The Asset Strategy network of companies has been providing financial wellness to individuals and families, as well as corporate and non-profit retirement plans. Asset Strategy assists clients with managing the risk responsibility of sponsoring retirement and investment programs and helping individuals achieve successful financial outcomes. With offices in New England, Mid-Atlantic, and Pennsylvania, Asset Strategy can help you create, manage, protect, and distribute your wealth. And today we have Kent Fitzpatrick, Managing Director, Michael Berwick, General Counsel, and John Gentry, Director of Retirement, here to give us a presentation. So I will hand it over to you guys.
Yeah. Jennifer, thank you. First, a quick clarification. Gentry's not with us. We have Sean Whalen, who's a partner in the firm and is very expert at what we're talking about. And one of our newest acquisitions, Russell Swinton, who's a wealth manager and a really talented guy, as well as Kent, who runs the company, myself. My name is Michael Berwick. I actually have a history with NEBBA. I presented to you guys, I'd like to say, back in 2015, 16. Okay. My videographer at the time was a woman that I had just started seeing. I was a single dad for a while, and we're married with a 3-year-old daughter at this point. And so it's nice to be back talking with NEBBA. I know that time is short, so I want to just kind of roll through this quick intro. Just to set the stage for what's going on here. Business brokers always have a challenge, and the challenge is for sellers who are reluctant to sell because they're fearful of the tax implications, and specifically the capital gains tax implications of what that sale might look like. And we're really here to talk about a couple of solutions to those problems that are designed to help the membership, and we're now all NEBBA members here at Asset Strategy, to help the membership tackle that issue, that problem, and to get sellers more excited about selling, less fearful of the tax implications. And this is all taking place amid a backdrop of a federal government, Biden administration, and Congress, who are looking to do some pretty serious things to the tax code that involves eliminating potentially the step up in basis on 1031 exchange and otherwise, capital gains taxes going through the roof, and just a whole variety of proposals that, whether they're passed in full or in part, are going to make it increasingly difficult and more challenging for the membership to work with sellers to actually sell their businesses and get them, again, less fearful of the tax implications of doing that. So again, my name is Michael Berwick. I'm General Counsel here at Asset Strategy. I'm also an attorney in private practice. And it's a pleasure to be here. With that, I'm going to actually flip to Ken Fitzpatrick, the president of Asset Strategy Advisors.
All right, thank you, Michael. So we're going to really do this in 2 parts, and we're going to, I guess, go pretty quickly because we really want to get to the Q&A section at the end. But I thought I'd start with maybe a primer or refresher on 1031, and I'll give you an example. We recently helped a marina sell their property, and that marina was the transaction was composed of 3 components. 1, there was real estate involved. Number 2, there was personal property involved, and 3, there was goodwill involved. And Section 1031 of the code has been on the books for 100 years. It was modified with the Tax Cuts and Jobs Act to only allow for the exchange of like-kind real property or real estate, and no longer the ability to exchange personal property. So think of the family farm where you have grain in the silo or tractors or whatnot. So any personal property is not part of that exchange. With that same tax code, they introduced qualified opportunity funds and qualified opportunity zones, which address capital gains. So I'm going to go through a primer with what 1031s are, how it works, timing. It you may be familiar with this. I'm going to switch gears with Sean, who's going to introduce the concept of what's called the Delaware Statutory Trust. And then we'll wrap up with an overview of the opportunity zone regulations. And then hopefully we'll talk fast enough to go through some Q&A. So with the 1031, I think a lot of people are under the impression or the assumption that I'm going to pay 20% long-term capital gains, which is not the case. Or if they say, well, gee, I only make $125,000 a year, so I'm only going to pay 15%. Well, that's highly unlikely as well, because the actual sale of a business or let's say a real estate asset, typically, especially in our area here in New England, is going to far exceed the income threshold. And if they've owned that asset for more than 12 months, they get the long-term capital gains treatment. So generally, we're talking about 20% long-term capital gains. If it's less than 12 months, then it would be ordinary income tax bracket. The other is the state tax at 5% for Massachusetts. The last two on the screen, I really call the gotcha taxes, because I think a lot of people aren't familiar with the 3.8% net investment income tax, or sometimes it's referred to as Obama tax, as well as the capital gain depreciation recapture, which is 25%. So especially when you're talking about, let's say it's a dentist practice and he owns the building, he's selling the building, he's selling the client list, and he's selling his equipment internally. That 25% depreciation recapture can amount to a big number as well. You have a 27.5-year depreciation life schedule, which is approximately it's 3.6% on a year-to-year basis for residential related real estate, multifamily or single family. Everything else is 39 years. So that depreciation needs to be calculated. This is just a quick snapshot. Some of you work in multi-states, so this gives you a breakdown. And this presentation is going to be shared as well. So why would someone think about doing an exchange, maybe outside of the sale of their practice? Well, one might be cash flows. If I bought a property, let's say 30 years ago, and I've done some improvements and whatnot. Well, maybe my rents haven't kept up with the actual value. I want to unlock the value of that asset. Maybe I've fully depreciated an asset, so I want more efficient, tax offsets. Maybe I want to be divided in different regions of the country. If you look at places like Florida or Texas, those are tax-free states. If I'm in a single asset class of an office building, maybe I want to be in industrial, Amazon fulfillment centers, or self-storage, or multifamily, or student housing, or senior housing. So it's a good way of diversifying your assets as well. And also part of it could also be estate planning as well. So again, like kind exchange does not mean that if I'm selling that office building as part of the sale of my business, that I have to buy another office building. Like kind means income generating property, but that also could be raw land. So maybe it's not generating cash flow, but it's for investment purposes. So it does not have to be the exact to exact. So what are the rules? You basically need to replace equity with equity and debt for debt. If you don't do that in the exchange, then you create what's called boot, which is essentially tax on the differential. And Sean will talk about in just a minute. Let's say I'm selling my business for $1.6 million, or my property for $1.6 million, and my goodwill and other assets above and beyond that. And I want to downsize. I want to buy an asset for $1.2 million, and I may have debt on that asset. So I need to be thinking about if I'm downstreaming, I'm going to create boot on that delta, Sean. At the closing, I need to engage what's called a QI, or a qualified intermediary. So you generally want to do that well in advance of the transaction. So at the closing, that QI is going to take constructive receipt of those proceeds, and then the clock starts ticking. So I have 45 days to identify a replacement property or properties, and I have a full 180 days to close. So 45 days plus another 135 days to actually close on that next property. There's 3 identification rules. One is the 3 property rule, where I can identify up to 3 properties. It's going to be right on my identification sheet. If I want to identify more than 3 properties, then I'm subject to the 200% rule. So let's say I sold an office building for $1 million, and I want to identify 2 or 3 or 4 alternatives. Well, if I identify that 4th, I can identify up to $2 million worth of properties, or 200% of, in my example, and I could operate under the 200% rule. We don't really see the 95% rule used very much, because what that states is I can identify as many properties as I want and even exceed the 200% rule, but I have to close on 95% of them. So generally in practice, it's identifying 3 properties or the 200% rule. And again, these are probably some of the similar benefits in terms of the exchange. Sean's going to talk about active versus passive real estate. So if I've been a landowner or business owner for the last 30 years and I want to go work on my golf game in Florida, but I don't want to pay all these taxes, maybe I want to exchange into a passive asset where I still get the benefits of depreciation offset. I get dependable, reliable income stream. I want to diversify the type of revenue, but I don't want to be a hands-on landlord. They talk about the terrible T's: tenants, termites, teenagers, and taxes. You get to a point. I've been a landlord for 25 years. Sean's a landlord. That maybe you want to see what else is out there. But so there is passive strategies that Sean will share in a minute. So with that, here's your key.
Yeah, thank you. Thanks, Ken. And thanks everybody for joining us today. So I'm going to just discuss a passive way to complete a 1031 exchange. Back in 2004, the IRS approved Delaware statutory trusts as a way for exchangers, 1031 exchangers, to exchange into other forms of real estate and still defer the taxes. So I'll kind of explain what DSTs are in a minute, but just kind of wanted to show you this quick little decision tree that we created. So once you have a business owner that owns property willing to sell, they have a couple of different paths they can go. They can go down the path of, like Kent mentioned, paying taxes up to 20%. California's 13.3 and going higher. Depreciation recaptures 25%, and the potential for the net investment income tax of 3.8. So that's one path that they just want to get out and pay the taxes. But us as wealth managers, we look at it a way to enhance their estate and continue their wealth building. So we always suggest 1031s as a viable options. And we'll explain opportunity zones in a second as well. But those are 2 powerful tax deferral options that are given to business owners today by the IRS. And the IRS doesn't give many. So that's why we try to educate folks like yourselves, investors, and so forth with these 2 strategies, just to really kind of give you guys a good sense of what's available out there. So once the money goes to, once an investor decides they want to go down the 1031 like kind of exchange path, and they hire a QI, qualified intermediary, then they have 2 other paths. They can either be active landlords or passive landlords. A lot of our clients are, getting up there in age, like Kent mentioned, they want to kind of retire to Florida or just do more of, leisure activities and not have to deal with tenants every day. So a lot of them like the passive approach that we have taught them and educated them on using Delaware statutory trusts. So DSTs are just a ownership structure. They've been around since the 80s, the Delaware Statutory Trust. But again, in 2004, the IRS approved them in conjunction with a 1031 exchange. So it just basically allows an investor to purchase a fractional interest in a high quality property or portfolio of properties throughout the US. So as you can see, there's many examples of DSTs out there. There's multifamily housing, self-storage, healthcare, retail, student housing, industrial, and office, just to name a few. But again, the whole concept is, a large sponsor will, buy, let's say, a 400 unit multifamily in Dallas, Texas. And what they do is sell fractional shares to 1031 exchangers throughout the country. And then they become the property manager, while the investor, the 1031 exchanger, just simply is passive investor and just receives their income and kind of allows the sponsor to do what they think is best for the property. These are Reg D investments, so your client base would have to be considered an accredited investor. The government wants to make sure, any real estate's illiquid. These are no different. They're illiquid for, up to 10 years. And we can, go into the details if you have some questions on that. But, you have to be an accredited investor, and here's the requirements. You have to have a net worth of $1 million, excluding your primary residence, or you have to make 200,000 as an individual for the last 2 years, or 300 as a couple. What are some of the potential benefits of a DST? Obviously, the tax deferral nature of it. A 1031 exchange, like I said, it is viable according to the IRS to use a DST. Tax forgiveness, kind of what Mike was mentioning about some of Biden's potential changes in the tax law. But right now, there's a step up in basis at death. So somebody could keep exchanging their real estate until death, and then their heirs would get a step up in basis, and therefore the tax would be forgiven. Higher quality investment grade property. Obviously, when most business owners are selling a property, they might exchange it into a local 2-family or industrial building across the street. This allows a much broader kind of access to real estate for their exchange. So they're able to kind of diversify from a geographical standpoint as well as an asset class standpoint. And that leads into the diversification to help reduce risk. You're not just betting on one property across the street or one industrial building down the block. It's you're able to buy in Florida, Texas, wherever you think is a viable option. With our help, obviously, we kind of give your business owner some help. There's some liability protection, and obviously there's monthly income, and also the debt replacement is also a benefit. And again, just what I mentioned earlier, the power of tax deferral. This is just a quick example for your business owners. If they sold a building, you can see, $1 million cost basis, and it basically kind of shows you that the net after taxes, we're using a 6.1. That's kind of a national average for the state tax. But your investor would walk away with only 700,000 versus if they did a 1031 exchange and deferred, they'd be able to start accruing, interest and, on that $1 million. So it's a pretty powerful tool, again, that we really enjoy and really like for our clients to kind of help create wealth over time.
Well, and I think another point to be said too is if I netted 700,000 to get the same yield that I would get off of investing $1 million, I'd have to probably be a little bit more aggressive, which someone at that stage of their life may not be interested in doing.
Exactly. And again, just so our biggest, hurdles when we talk to investors is they don't want to pay the taxes and they don't want to be an active landlord anymore. So this is one of the solutions we use to really help that we thought, for your clientele could be really impactful when discussing, selling price and things along that line. If they're saving, from a deferral of taxes, almost $300,000, maybe they're, and that $1 million is unreasonable. Well, maybe now they're okay with $900,000 as a sale price because they're able to defer those taxes. It's just a great way to kind of educate them on.
One other comment in this particular market. I mean, we're at a all-time high in the stock market. Yields are at historical lows. So I think that the search for yield is also another part of the conversation, because if they sell that fixed asset that they've been running their business for the last 20, 30, 40 years, they need to replace that income stream, and they would need to do so on a tax efficient basis. So I think the idea of being able to still be invested in physical real estate is comforting to a lot of people that don't want to be in the stock market, and they don't want to get anemic yields in the bond market either.
Right. What are the risks of a DST? Just similar to real estate, they're illiquid. There could be tax law changes in the 1031, lack of liquidity. Any type of real estate investment could have troubles along the way. But we vet our sponsors pretty thoroughly. Our broker dealer does as well. So we can kind of go into all each investment has their own pros and cons. So we can definitely discuss and kind of go over those as needed. Opportunity zones. This is the other piece that we use for our clients. This is in conjunction with any sale. It's just not real estate. So this is where, if you sold a business, sold stock,
Goodwill.
And like Ken mentioned, we've helped many businesses. The most complicated one was a marina. It had a restaurant. It had goodwill, had a bunch of, land buildings that we had to really help out. So we did a combo of 1031 DST plus opportunity zones, qualified opportunity zone funds to really help that client defer a really good chunk of what they were going to pay.
Sean, that's a good point. It bears repeating that these are not exclusive strategies. These two strategies that we're talking about right now, as well as a number of others, can be used in conjunction with each other. So for everybody that's a business broker that's out there thinking, all right, the niche that I'm in the business brokerage community really is not related directly to real estate. We're selling businesses that are mostly valued at goodwill and everything else. This is a solution that makes up for that as well.
Thank you. So let me just give you a quick little background on how Opportunity Zones got started, and then Kent will kind of finish you off with the details. But Sean Parker was the original kind of really thought of the concept of Opportunity Zones. He was created Napster, but he was also the first president of Facebook. So he had a lot of embedded gains from his Facebook stock, and instead of just selling and paying the government, he thought there had to be a better way. So he kind of worked with Senator Tim Scott out of South Carolina, who's a Republican, and Cory Booker, who's a Democrat out of New Jersey, and really kind of got it in this bill, Investing in Opportunity Act, it was the original name, but got opportunity zones into the Tax Cuts and Jobs Act of 2017. And it was actually a bipartisan supported initiative. Obviously with Scott and Booker, everybody really jumped upon it and really thought it was a great tool. So the basic gist of it is it connects people with capital. Those are the investors that have large capital gains. And it connects with what's called opportunity zones, which is the lower income type areas that each governor kind of designated a few years ago. There's 8,700 different zones throughout the country. And I'll kind of give you a quick little map in a second. But basically, opportunity zones investments are created to help drive real estate development, job creation, and overall economic growth. And obviously, that can have a compounding effect on the original investment. So Cory Booker a few years ago said, opportunity zones are domestic emerging markets. So really interesting strategy that's been in play for a number of years now. And we've used it quite often for a number of our clients on the particular situation. But this stat's a couple of years old, so it's obviously even more. But there was $6 trillion of unrealized capital gains. So it was a way for the government and communities to kind of get that capital gains in motion. So obviously there's some tax breaks for the investor to sell and invest their capital into these opportunity zones. And Kent will kind of discuss that in a minute. So here's kind of a high level kind of area of the rust color is what opportunity zones are. Obviously, this is you need a finer tooth comb to kind of get into the details, but there is the website. It was eig.gov.
eig.org. You can actually go in an interactive map. You can put in an address to see if it happens to be in an opportunity zone. Just an important point of clarification. We'll go through what the tax benefits are in just a moment, but you don't get any benefit of owning property in an opportunity zone, or O zone, we'll refer to it as. You have to actually invest any or all of those gains into a qualified opportunity fund. So I just want to make the distinction between the actual zones, which are shown in this map, versus the funds which are investing in real estate or businesses in these particular zones.
Oh, and with that being said,
there we go.
Segue.
So really, these are the three things that you need to remember about qualified opportunity funds and fund investing. You get to defer paying your tax. Now, 2021 is an important cutoff because it's really, you have to invest any or all or a portion of a gain before the end of 2021 to be able to defer paying that tax, because you have to hold it for 5 years. That's why the calendar. So you get to defer and use Uncle Sam's money in your investment for the next 5 years. At the end of 2026, or actually April of 2027, when you pay your taxes, you get an exemption. You get to deduct 10% of the amount of tax that you would actually owe. And then if I hold that investment for a full 10-year time frame, I pay no future capital gains. So I'm going to defer the tax I owe today. I'm going to be able to reduce the tax I owe by 10% when I pay the tax bill in 2027 in this example. And then I get to defer any future capital gains. So if you go to the next slide, I think there's an example.
Just to skip ahead.
Okay, all right. So I'm going to just give you a verbal example, then I'm going to go through an example side by side of paying the tax or not. If I had $100,000 basis in Apple stock as an example, and as Sean and Michael mentioned, it's not just the sale of a business, it can be any capital gain. And I sell that Apple stock for $1.1 million. I have $1 million capital gain. I can take my basis off the table and then reinvest all of that $1 million gain or some portion of it, and I get the benefits of deferral, reduction, and elimination of future tax. So let's walk through an example here. On the left-hand side, both examples, we're taking $100,000. We're going to use a 14% internal rate of return. And the tax example we're using here is actually based upon California, where we're using the 20% federal, 3.8% net investment income tax. I think it's 13.3 for California tax. And I don't know if that also is factoring any depreciation or not. So in the example to the left, $100,000 investment, I paid my 36.5 in tax. So I'm left over with $63,000, which I then invest at a 14% rate of return, and it grows after 10 years to $235,000. I then have to pay my tax again on the gains I just created from the 63 to 235. And so I'm netting 172,000 in this example, or 5.6%. The example on the right, I have a $100,000 gain. I pay no taxes for the next 5 years. That 100,000 at 14% grows to $370,000. Now I do have to pay the tax in 2027, but I'm not at the 36.5. I'm paying it at a 10% reduction of that. So in this example, I'm paying $31,000 versus $36,000 on that original $100,000 gain. So I have $339,000 after paying the tax. In the example to the right, because it was reinvested in real estate, I also got the benefits of depreciation pass through to offset any income. So in this example, the net return is 17.8. So again, even if you can advance, even if the tax rates go up, I think there's a slide I wanted to share, Sean, that showed the tax rates example. No? Okay. Well, I was going to give the example that in the current long-term capital gains at 20%, and if the proposal of 39.6 goes up, the benefit of the compounding and tax-free growth and the elimination of future tax outweighs paying the tax now in a lower tax environment. I do want to try to maybe wrap up so we can take some questions, but we did include a table here. We'd be happy to share this with any of the members that compares the 1031 rules and provisions side by side with qualified opportunity funds. But why don't we, Jennifer, if you want, I know we covered a lot of information in a short amount of time, but I told you we would try to leave 10 minutes at the end just to take some questions.
Yeah, and the questions are in the chat box. People have been sending them in as you were presenting.
Okay, we'll just pull that up at the bottom.
Yep. So if you want me to read them, or if you just want to.
So why don't you read them, Jennifer?
Yeah.
Do you see them, or do you want me to read them to you?
Why don't you read the first one? We're just teeing up the full screen
So,
view.
Can 1031 exchange be done on foreign properties and double taxation treaties? If yes,
No.
The answer is no, but the answer to opportunity funds is a possible yes, because it includes 6 territories outside of the 50 states, or potentially 51 states if Washington becomes a state.
52 in Puerto Rico.
Yeah, yes, yeah. So this is a domestic only provision with 1031.
So we have the questions up.
Oh, we can see the questions now, Jen.
oh, perfect.
All right, Sean.
So can the trust invest in multiple like-kind properties? Yeah, most of the DSTs try to stay in one sector, so asset class. So if it's multifamily, they might buy 2, 3, 4 multifamilies in that one DST. If it's a self-storage, they'll just stick it, keep it to self-storage. So it could in theory, but usually it's just the same asset
But I
class.
think it's possible that the question also meant like, on the sale, can they invest in different DSTs? And the short answer is absolutely.
Yep.
You'll achieve all different types of diversification, as I think was mentioned, geographic, asset class, the sponsor would be different, et cetera. And we do that. We mix and match at a very high level.
I'll take the next one. So the question was, so I have a 30% tax savings. What does the income look like and what timeframes? So maybe I'll address that from both a 1031 Delaware Statutory Trust response and a separate one from qualified opportunity funds. So we actually track the DST marketplace is about a $5.2 billion marketplace. There's approximately 35 to 40 fund sponsors, which probably promote anywhere from 120 funds, and it's a fluid marketplace. So we track all of the different fund sponsors out there, and I could tell you that the range of yield right now is probably a low of, let's say, 4.25% to maybe a high of 6.25%, 6.5%. And that's going to really depend upon the asset class and the sponsor and the actual fund and what real estate it's investing in. Do keep in mind though that because you're getting depreciation offset, you could have let's take 5% as a middle ground. If you had a 5% yield, but you have depreciation offset on that 5%, the taxable equivalent on that 5%, depending upon your tax bracket, could be north of 6.5%, 7% on a taxable equivalent basis. On the opportunity fund side, what you need to understand is you're buying opportunistic real estate. So a lot of this is brand new. You're buying shovel-ready projects, so they're typically not going to produce income for anywhere from 18 to 24 to 30 months, depending upon the project or the asset. So a lot of the funds that are out there will provide what's called a preferred dividend. So until they build the asset, stabilize the asset, you won't get income off of it. But you're buying opportunistic real estate. So usually the yield assumptions, because there's more risk where it's not an asset that's been constructed, would produce a better yield, better return. So hopefully I answered that for you. Sean, you want to?
So I think this question basically was answered with what you just said, but what is 7% IRR return example?
Oh, IRR, I'm sorry for using acronyms, internal rate of return. So that's basically what the annual yield would be on the investment.
And I can get this one. Does the QOF end on 12/31/2021? So that answers no. So there's the reduction piece ends at the end of 12/31/2021, but the actual legislation is for a long time ahead. So is asset strategy similar to crowdfunding sites in terms of creating a marketplace for OZ 1031 investments? No, we're not like a crowdfunding site. We have access to certain sponsors through our broker dealer from an opportunity zone fund, as well as a 1031 DST investment side. So we can help educate clients and kind of give them the pros and cons of each investment, but we're not.
Yeah, and maybe just to expand on that, crowdfunding falls under what's called 506C of the code, where that's basically a direct to consumer. And I would say buyer beware. I mean, some of you have probably seen some of the commercials. They're touting 18 to 24% returns. Be careful, do your due diligence. 506B of the code is basically something that is only available as a securities instrument through a licensed securities representative. So when we are representing either Delaware Statutory Trust sponsors or qualified opportunity funds, it's done as a licensed securities individual. So it's a different delivery.
And I think just to expand on that for a second, what you're seeing with these advertised deals is what's called a general solicitation, and that's something that we're not involved with. And what the area of products that we deal in, programs that we deal in, is at a very, very high level. And typically, before it gets on our platform, it's been through at least 3 different levels of due diligence at 3 different stages. So.
The next question, I'm sorry, we're kind of pressing, we got a short amount of time here. What are the typical fees associated with either program? It's really unique to the sponsor and it's really unique to each fund. What I would highly recommend is that you look at what's called a PPM, or a private placement memorandum. Again, these are for accredited investors only. So the private placement memorandum will give all of the facts, all the details, all of the business plan, the assumptions, growth rates, cap rates, purchase prices. So every fund, every sponsor, it's going to be unique in terms of what the fee structures are. But when we are quoting yields, that's net of all fees and expenses in terms of a yield to the end investor. Anything at the top?
That's it, I think, Jennifer.
Scroll back to the top.
It pops up at the
Yeah, does anyone else have any last minute questions?
At 11:58, we actually did it all on time.
I know, that was very prompt.
Yeah. The one thing I do want to add, Jennifer, is in terms of opportunity funds, Massachusetts, unfortunately, is a non-conforming state. It's one of, I think, six states that are non-conforming.
Soon to be 7, I think. New York is about to opt
That's
out.
right. That's right. So you still would have to pay your capital gain at the 5% for Massachusetts, but you would, in the opportunity funds, be able to defer all of the other taxes that we talked about at a federal level.
And again, just this whole presentation was for you guys to have in your back pocket in case you have those business owners that aren't realistic with some of their selling prices. Now you have some tools to maybe kind of help them understand what, tax deferral strategies, and obviously we can help, guide or at least educate the owners as well to maybe loosen up that pricing point that they have and help you guys sell those businesses.
Yeah, and from a practical standpoint, if I may, Ken, it's really simple. I mean, we want to partner with you guys. So when you are face to face or Zoom to Zoom or what have you, with your clients that want to sell and are concerned, at this point, as Sean said, now you've got the tools to say, hey, relax. I've got the group that we work with that can solve this problem and make the tax situation a lot less painful. And we've got other strategies beyond the ones that we talked about, monetized installment sales, structured installment sales. And Ken, I don't know if you want to just tell them where they can find that on our website.
Yeah, so we do have a resource site. Our main website is assetstrategy.com. And then we do have a section that's called Tax Advantage Wealth Strategies, where we highlight both the things we talked about today with 1031 opportunity zones. There's a few other strategies, as Mike mentioned, 453 installment sales, qualified small business stock, qualified improvement properties. So there's a few different concepts that use that as a resource site. But I know we're out of time, but thank you all for allowing us to speak to you guys today, and hope this was beneficial.
Yeah, thank you so much. This was a great presentation, and we never have those issues with sellers.
Right.
But we're like they said, Asset Strategy, they are a NEBBA member, so their contact information will be on NEBBA, and I can also provide it to everyone when we send. This presentation was recorded, so I'll make sure everyone has the contact information. So thank you again for this presentation, and everyone have a great day. And our next
Thank you so much. Thank you.
Our
Nice
next
to be with you.
meeting will be June 9th. Aaron, can you make sure I save this correctly? How do I make sure
Absolutely.
save this recording?